Welcome back to Money with Mission, where we believe every woman should have the financial ability to walk away from any job or relationship that is not in her best interest. Today we have John Ensley, Chartered Financial Consultant. John is leading a financial planning revolution to help you take back control of your money, your lifestyle, and your passive income requirements. John believes ordinary financial planning is failing too many of us. After losing almost everything during the Great Recession, just like me, John became obsessed with finding safe, predictable ways to save and create wealth, protected from the chaos and corruption of the conventional financial system. Today, he helps clients implement the simple and proven systems he discovered, unknown to conventional financial planners, stockbrokers, and advisors, to save and create wealth while minimizing the wealth-killing effects of what John calls money monsters. I'm excited to find out what John calls money monsters.
Be the change you want to see. Make a difference by giving your money a purpose, a mission to do good. Welcome to Money with Mission, where we show you how to create passive income so that you have options for how to work and how to live your life while leaving a legacy of positive social impact.
You guys, today we have John Ensley. And John is going to help us understand a lot more about our money. I think we're getting there. I was just reading something about knowing, once you know something, it's so hard to unknow it, and getting your eyes open to all the things. I just want us to see all the financial possibilities out there so that you can then choose what you want to do. Welcome to the show, John.
Thanks for having me, Felecia. I'm super excited to be here.
It is exciting. I was looking at some of your stuff, your LinkedIn, your website, and you talk about retirement. And I know most people think about retirement as an age, and it's they're working a whole life to get to this retirement. What is your definition of retirement?
That is a great question. So I think that definition is shifting. My parents, my grandparents' generation, it had to do with the day you were going to stop, quote unquote, working,
Right.
and start having leisure activities.
Yes.
Or whatever the case may be. A lot of the clients that I work with, and I know for me personally, I don't know that there's ever going to come a point where I stop, right? I think I'm going to continue to do something at some level till they nail the coffin shut is what I like to joke about. So I think that definition has definitely shifted for a lot of people. For me, it's never been about an age. It's really about health, right? At what point will your body or your mind fail? And then you have to have contingency plans to deal with that eventuality.
Okay.
But until that happens, I want to be productive. And, I love what I'm doing currently, and maybe I'll be doing that until they nail the coffin shut, or maybe it'll transition into some other endeavor 25 years from now, right? We'll just see what life brings us.
We'll talk about your transitions. John's had a couple, as most of us have. So I talk about retirement as being able to do what you want, when you want, with who you want, no matter what age you are. And I don't think enough of us think about it that way. We get taught from very early, go to school, get a job, save your money so that when you get to retirement, you have this plan. And we know the age of retirement is changing. The government changes it. It is a government-driven thing, just like our 401ks are. So talk about 401k and how that fits in or doesn't fit in or works for or doesn't. Just give me your thoughts on what 401ks are and what they're good for.
Absolutely. So a 401k, just the quick definition, a 401k is a government-sponsored tax advantage program where the government says you can take your savings and put it in this vehicle pre-tax, so you don't pay tax on that money this year. And in exchange for that, we are going to tax it all much later when you really have no idea what that tax consequence may or may not be. So that's the trade-off. We're letting the government kind of dictate the terms of our savings. And not that that's a bad thing, right? That can be a great thing. Some people are in a position where they have great matches from companies and you can build up a lot of wealth that way.
I want to time out for a second because you said something that I think needs to be said again.
Okay.
We let the government dictate our savings. I think that's what you said. Can you remember the words?
The government dictates the terms of how we save for retirement.
Do you like that? I mean, did you hear that, you guys? The government dictates the terms of your savings. The other thing we're taught that you may be getting to is that we'll be in a lower tax bracket when we retire. So you'll pay less taxes than you would pay now. And then when you really think about that, who wants to be in a lower tax bracket when they retire?
Exactly.
I want to live life the way I want the money I'm getting now then, so I can do what I want to do. I'm sorry. I had to just, that was a statement that
I'm
was
glad you zeroed in on that point, right? The whole tax bracket thing, I can tell you from working with clients for the last almost 12 years, I work with a lot of clients that are in their 60s and 70s and that are either about to retire or have retired. And the biggest problem that they have with 401ks and IRAs and these types of tax qualified plans is that they don't necessarily need the money. They're not in a lower tax bracket. They're in a higher tax bracket. And then you reach a point, age 73 currently, where you have to take the money out. And so some of these folks are being driven into higher tax brackets that they don't want to be in because they don't have any choice anymore. So that's the biggest thing about those types of plans for me, is that they take away control, they take away autonomy, they take away your ability to kind of design the life you want to design, the way you want to design it. Because while you're young enough to do those things, you've essentially locked that money away. You really can't access it. And then when you're old enough to access it, at that point, it's kind of taking your options away in terms of how you use it. So for me, I want more freedom and control over my money than that.
I mean, I'm a surgeon, I'm a urologist, and many of the women that I work with and talk to are physicians and surgeons or some highly paid executive type person, and control is one of our things. So I hope you guys heard that what we are doing with our 401ks and that type of retirement plan, air quotes retirement plan, is giving away our control. I suspect, and I don't know, that possibly, do you think the age that you have to withdraw will increase or decrease? I mean, I know we're both speculating here.
Correct. Yeah.
I mean, to me, it seems like it would decrease because they want you to start taking your money out so that you can start paying taxes sooner. And again, the government's dictating your savings plan, so they can make the rules whenever they want to make the rules. So it could turn out that you have to start taking your money out at 70 or 69 or 68 when you really don't want to and have to really start paying taxes. So
and the age was 70 and a half here just a few years ago, right? So these increases to age 73 have come from legislation just in the last few years. And that legislation is in a response to an economic situation that I think everyone knows is a little troubling. So I agree. I think those ages are going to start coming back down because there's going to be a transition. Speculating. I'm glad you said that. I am speculating right now, right? This is my opinion. I think there's going to come a transition point where the spinning the plates is going to be over, and the piper will have to be paid in terms of the government and the programs and all the funding for those programs.
Yeah.
And so they're going to start ratcheting the pressure up on the population to get that tax revenue to keep these programs going. Whereas right now they're kind of spinning plates to keep that going. We haven't felt that pain, but I think if we look rationally at where things are, that pain is coming. It's just a matter of when it gets here.
And unfortunately, so many of us are not looking. We're moving down the path like this. I'm going to work every day, and I understand. You go to work, you might be operating on somebody from 7:30 in the morning till 5:30 in the evening. It's just you don't have time to think about it. But these are really things that we have to think about to realize that we aren't in control of our money when we're giving it to what we're doing right now. Most of us to the 401k. We're saving for retirement that is dictated by somebody else. Let's get out of the depressing part. Okay. Let's get out. When I get in these conversations with friends, I'm like, let's get out of this. Let's get out of this ickiness right now.
Yes. Let's move on.
You have an interesting way to help us with this. You talk about bank on yourself. Before we go to that, talk about how banks think. How are banks thinking differently than I am or than other people or necessarily than the rest of us think? Let's put it that way.
Well, I think the main thing that banks do is they're very, very good at getting money to make money at multiple levels, right?
Okay.
So a bank is taking a deposit from a depositor. They're paying a tiny bit of interest, especially right now on those deposits. They can then leverage those deposits multiple times, 10 times as much, and then make loans at many, many, many times the interest they're paying on the deposits.
Okay, let's put numbers to that. Because I want people to understand that. It took me a while. So I put $1,000 in the bank. Let's just
You put $1,000 in the bank, they're paying
Yeah.
you what, 1/4%,
1/4% interest.
0.5%, right?
Whatever.
Something like that.
Yeah.
They can then take that $1,000, and I'm putting this in very simple terms. It's much more
Yes.
complicated than this, but they're
Yeah.
taking that $1,000 and they can then essentially out of thin air loan $10,000 out to various borrowers with that $1,000 in reserves. In other words, they have 1,000 in cash. They can give 10,000 in loans using the 1,000 as collateral.
Right.
And they charge right now 7, 8, 9, 10%. So they're paying you, the depositor, 0.5%, and they're making that arbitrage, that difference.
Yeah.
And so it's that arbitrage is how banks make money.
So
Leverage and arbitrage.
Arbitrage is a word that took me a long time to understand. So I'm going to have us go back because I think a lot of people just like, what is that? Explain arbitrage.
Arbitrage is that I can pay 0.5% and make 10%. The arbitrage is that 9.5% difference. That's basically my profit.
Okay.
On that transaction.
You know what I think my hardest thing was arbitrage was is it sounded like a verb, but it's actually a noun. I think that was the hardest thing on that. Like, how do you arbitrage?
Right.
I was like, no, you don't arbitrage. It is arbitrage.
It is arbitrage, yes.
Got it. Okay. So you guys got what banks do and how banks are making money. You give them money, they pay you a little bit, they loan out your money at basically, as John explained it, 10 times the amount that you gave them to different people, different entities, and they're receiving interest back higher than what they're paying you. They're losing nothing. So the arbitrage is what they're getting compared to what they're giving.
Now, there's one other important point to that, Felecia, and that is this is all driven by the average individual's need for credit.
Mm-hmm.
Right?
Okay.
People need money to run businesses, to make investments, to buy things, to, right, whatever the case may be. So that everyone has a need for credit at some level. And that's what drives this whole banking process is that need for credit that people have.
Got it. All right. I want to bank on myself. What do I do?
So bank on yourself, we'll call it an alternative concept to the conventional banking system. I want to be very, very clear. It is not banking in the legal sense of the word. That word is used as a descriptor to sort of this process, but it is not banking. It is something completely different.
Got it.
And so I stumbled across this myself. And it's why I made the career change I made in 2012 was I discovered kind of this concept and that very few people are being educated about the concept and was ready for a career change. So this is what I started doing in 2012. And so Bank on Yourself uses the unique features of specially designed life insurance contracts that are designed to accumulate cash value very, very rapidly compared to what most people think of in a whole life contract. And then most people are not aware of what happens with a whole life insurance company that issues these contracts and you build up this cash value. They will loan you money using your policy as collateral, essentially. So let me explain how that works a little bit. An insurance company is heavily regulated. They have to invest in certain high quality assets in order to maintain their promises, and they're overseen by a insurance commissioner system that's run at the state level to make sure they're doing that. So it's very, very regulated. An insurance company can't just go out and invest in crypto. They're just not allowed to do that.
Okay.
So one of the investments that the regulators like a lot is when an insurance company gives loans to its own policy owners.
Okay.
Because that's very, very secure, right?
Yeah.
And so the insurance company essentially will loan you as a policy owner. They will loan, not all companies do this, but quite a number do. So they will loan me as a policy owner and against the policy that I own. So let's say I've had this policy and I've built it up and I've got $100,000 of what's called cash value.
Mm-hmm.
And so that's essentially cash that's in the policy, which is not separate from a death benefit, but we're talking about the cash part.
Gotcha.
And they'll loan me up to the amount of that cash.
Yes.
Is the limit of what they will loan me. And the death benefit on that policy is the collateral. So in other words, if they loan me 90,000 of the 100 and I die and I haven't paid the 90 back, they're going to offset the 90 from, let's say, a $500,000 death benefit that's in that policy. Okay. So that's where it works. The death benefit is essentially the collateral. The cash value is the limit of what you can borrow. So what you're doing is you're not, and this often gets portrayed incorrectly with Bank on Yourself, or sometimes this is called infinite banking, is that you're not borrowing from your policy.
Right.
You are borrowing from the insurance company as part of their overall investment portfolio.
Okay.
And they're using the policy as collateral.
Okay. Got it.
So I borrowed this money from the insurance company. Now there's a couple of things. One is the insurance company is going to charge me some interest to do that because I'm part of their investment portfolio. That interest is simple, however, it's not compound interest, and they only apply it to the policy once a year.
Mhm.
And so there's an accounting function here that creates some benefit for us when we borrow. So we can borrow the money at, like right now, most companies are loaning at 5% simple, 5.5%, 6%, depending on the company, which is a great rate in the current environment. But when you factor in that it's simple interest, it's even better.
Yes.
And then the next thing that happens, because they're applying this interest once a year, so we borrow the money, and because the death benefit is the collateral, we get to decide how we pay it back. We're in complete control. We'll use that word.
Mhm.
We're in complete control of the repayment terms. So we can pay it back any way we want to over any amount of time. We can start payments, stop payments, increase, decrease, however we want to repay. We're in complete control of that.
Okay.
And so it
Yeah.
creates this environment, particularly for investments and things like that, where we have a lot of control. So think about if you're an investor, and I have clients who flip properties.
Okay.
So they can borrow money against their policies, purchase a property, not make any payments on that loan as they are going through the process of rehabbing. And so then they pay that loan off when they sell the property. So, right. It gives them that huge flexibility where they're not maintaining debt during that rehab process. So that's one example where this can work as an ideal source of financing. And so to circle back to the banking function, we're essentially doing what banks do in that we're able to use cash to fund a life insurance policy that creates this environment where we can now borrow money at extremely favorable terms and leverage that into other investments. We can use that cash to invest and essentially create that arbitrage. We can borrow money at very favorable terms and create cash flow and arbitrage that difference.
John, when you're paying your debt to yourself back, or you're actually paying your debt to the insurance company, well, I'm not sure exactly how to say that, but can you pay it at a higher interest rate than you borrowed it?
You can, and what
that way?
and what that equates to is you're paying it faster.
Okay.
Right. So you could say, okay, I borrowed this money at X. What I usually do with clients is, let's say somebody's going to use this to purchase a vehicle, finance a vehicle. So what we'll do is we'll go out and look at what's the market rate for cars right now, typically. And then we'll figure a payment out based on that rate. And that's the payment they make to their policy. And in effect, maybe that's based on a typical 6-year auto loan, but they'll pay that loan off to the policy in like 3 years.
Got it.
Because they're making that higher payment.
Got it. I know you're not a tax professional, but how does this, neither one of us are tax professionals. We're talking like we're over coffee. So please, whatever we're about to say, check with your own accountant, tax professional. How does this affect, or how can this play into your tax planning strategies?
So from an investing standpoint, there can be a number of advantages. One of the things I talk with all the time with professionals and business owners is your accountant needs to be involved, right? If we're going to use the policy this way, we need to have the accountant involved, again, because I'm not a tax professional and we need to have one on the team.
Yes.
So we'll say that first. And then, so from an investment standpoint, there can be a number of tax advantages. So if I personally take a policy loan on my policy, and let's say I use that to buy some equipment that I need for my medical practice, right? I can then lease that equipment to the medical practice.
Okay.
The medical practice is paying me lease payments that with working with my accountant, determine are what the IRS will consider reasonable. And then I'm taking a portion of those lease payments and paying the policy loan back, right? So we've created a couple of things there. One is I probably have some investment expense I can write off personally on the policy loan. I've created lease payments flowing from my business back to me personally, which means that's passive income. I can probably not pay self-employment tax on that portion, right? So it's a way for me to pull some income out of the business in a tax advantaged way. I also have depreciation on that equipment. And so there's a multiple levels of tax advantages that can be built into being able to use financing this way. And I can't stress enough that your accountant needs to be involved there to make sure that it's set up correctly, that it's reported correctly, that, that everything's being done the right way.
And we talk about this, you guys, often about having your team. We're not talking about your accountant that you meet with April 1st to get your taxes done on April 15th. We're talking about somebody on your team that's intimately involved in your financial decisions, that whenever you're about to do something, the first person you think about calling is that person so that they can walk you through what's the best way to do what you're looking to do. I think too many of us wait and think taxes are just taxes and we pay them on this day. There's a whole planning and strategy that can help you keep more money in your pocket when you have the right people on your team. And that's part of what John's talking about here. I want to go back a little bit, John, to what you said. You're talking about simple interest and compound interest. And I don't know that everybody knows what the difference in those two things are. So let's just clear that up real quick.
You bet. So compound interest is basically paying interest on interest. And simple interest is paying interest on the balance, just the balance. So your credit card, your mortgage, your car loans, these are all compound interest. You're paying interest on the interest over the term of the loan. And simple interest means you pay an interest rate based on the balance, and that's it. It's simple.
Okay. And these policies that we're talking about, you pay your interest once a year.
Correct. And what they do is they capitalize that interest and just add it to the balance. So you never write a check for interest, so to speak. And what that results in is your payments all year long are 100% principal. So they're dollar for dollar reducing the principal. And then they add the capitalized interest in on the anniversary date.
John, when should somebody think about doing this? Do they wait until they're halfway through their career? What's the best time to do something like this?
Well, there's an old proverb that says the best time to plant a tree was 20 years ago, but the second best time is today, right?
Yes.
So it's a cumulative process. So building up cash in these policies is an accumulative thing. There are certainly ways to get big lump sums into policies and make that happen, but by far, most people build them up over time. So the sooner the better. And, start with where you are and build up from there, right? I know people personally that own upwards of 40 policies.
Yeah.
So as your financial ability expands, you just keep adding them and keep putting money into them. One of the important distinctions with these policies, if I can, Felecia, is that I never consider a policy an investment.
Okay.
These policies are a container that we hold cash in.
Okay.
So they're a place that we can take cash out of our income or our investment activity, and it's a placeholder where it's going to grow, right? It's going to grow over our lifetime that we have access and control over. So a policy isn't an investment. It's that thing we use to go make investments. It facilitates every other kind of investment, whatever your thing is. A lot of people are into real estate, but it could virtually be anything. I've used it for starting businesses. I've used it for real estate. I've used it to buy vehicles and sailboats and, just about anything. It's a facilitator. It's not the investment itself.
Got it. The other thing I wanted to kind of point out, and I thought you were going there, is that don't think about it as just life insurance. It is a container for money. I think too many of us think of life insurance as that thing you want to leave to your family when you die so that they can take care of things after you die, or they can have something to do.
Mm-hmm.
But this is more about living, and this is about being able to do with your money what you want while you're living. And there'll be some left when you're gone, if you want that to be the case, so that you can leave that to your families. So that's another thing. And so I think a lot of people think about life insurance as something they like, I'm 20 years old. I don't need life insurance.
Mm-hmm.
But if you want to be your own financier, you want to finance things yourself. If you start at 20, you may be able to finance your own house when you buy your house, finance your own car, and you don't have any of these outlying loans. And then I can hear people saying, well, what about my FICO score?
Mm-hmm.
Because that's that middle class thinking is I've got to keep my credit score up. How do people get, and that's a whole mindset thing, but that's a whole nother conversation. I guess you take loans out if that's the thing you're worried about. You have those kind of commercial loans out there just so you can keep that FICO score. Is that the way you would deal with that?
If If you're super concerned about FICO score, then yes, right? Just use commercial loans, but you can also use the policy to kind of handle those as well.
Oh, nice.
So, you can go take out the car loan and 6 months into it, pull the money out of the policy, pay the loan off, and then finish paying it back to the policy. So that way you've got a current car loan that you held for 6 months, you paid it off. Those things will help your FICO score. It's going to cost you a little interest to do that.
Yeah.
Credit cards, right? You can put a little bit on your credit cards here and there to keep your credit looking good, and then make sure you're paying those balances off and you're not paying that crazy interest. So there's things you can do to maintain your score. But I think there also comes an awakening at some point when you get these policies to a certain point that, you know what? I don't need a bank ever again, potentially, right? Depending on the project. I probably could get by without ever going to a bank again. And so that score becomes less important in your mind.
Exactly. This is really, really good stuff. I wish we had an audience so we could ask people, what questions do you have? What questions
That'd be great.
are out there that, I know I was going to ask you about. One of the things you have on your site is about talking about wiping out debt. So we know that so many people go to medical school, law school, their professional schools, and take out loans to be able to do that. How does this help wipe out? I think we kind of got to it, but let's get real specific on just wiping out your student loan debt by using this type of vehicle.
Yeah, exactly. So I have a process that I use with clients that are in that situation that I call debt alchemy. And so it's essentially a tool where we build up equity in a policy. So at the beginning, we prioritize getting cash flow into the policy, right? So we need to build up some cash values we can work with.
Yeah.
And once those cash values build up a little bit, and that can range, I have, some folks that I've worked with are in a position where they can put $40, $50, $60, $80,000 all at once into a policy, and we can start this process immediately. Other folks, it might take a year or 2 or 3 to build it up a little bit.
Okay.
And in the meantime, we kind of maintain those minimum payments on the debt that we're going after. But once we have that ability, then we can start taking chunks in policy loans and paying off debt. And we take the payment that was going to that debt and we direct it back to the policy loan.
Nice.
And so as those balances on the policy loan are getting paid down, it works like a HELOC or a revolving line of credit. It makes that cash value available again. And so periodically taking another chunk and paying off, the next credit card or the next student loan or the next chunk of the student loan. Yeah. Until we have transferred basically all the debt someone has outside to their inside to their policy. And they're then taking those payments, right? So we're not changing their cash flow necessarily because it's the same payments they were already making.
Right.
We're directing that into the policy. And I have a tool the spreadsheet tool that I use to help people map this out depending on how complex it is. And we'll be able to tell exactly, when they'll be debt free and exactly what their cash flow is going to look like. So it's a really powerful tool to, that's why I call it alchemy, because we can transform debt and we're simultaneously creating wealth within the policy. The one thing we didn't talk about is when you borrow from the insurance company and you pay yourself back, there's something called non-direct recognition.
Okay.
And this is where the insurance company essentially doesn't recognize the loan. And so they're continuing to pay the growth and the annual dividends into your policy as if you didn't borrow the money. So not only do we have competitive rates, the policy continues to grow in the background as if that 90,000 that we talked about earlier was still there.
Okay. I'm not sure I followed that. So back up. We had $100,000 cash value. You borrowed 90 of it, and that's collateralized. Your death benefit is the collateral. Your policy is a collateral to that loan.
Yep.
Now I only have $10,000 of cash value because I took out 90. And say again what you just said about the non-recognition.
Okay, so what that means is in a whole life policy, actuarially over time, it accumulates cash value. So that's a guaranteed growth in the policy. We like to kind of tongue in cheek say the policy is going to grow by a larger amount every year for the rest of your life, and there's nothing you can do about it. Right? Okay. It's just going to grow. Then the second component of growth are called dividends. And then basically when a mutual insurance company performs better than expected, they pay a dividend out to the policy owners. Okay. That dividend is not guaranteed because it's based on performance, but that's the second component. So I borrowed this 90,000 and so I have 10,000 left. The insurance company, let's say I spend 5 years paying that 90,000 back. During that 5 years, the insurance company is going to credit my policy with the same amount of guaranteed growth and the same amount of dividend based on 100,000 of cash value as if that 90 was not borrowed.
Got it. I brought up another question in my mind. How do I accumulate cash value? We talked about that, but that now is the how. I have
Yep.
a policy. I paid for my policy. Where does the cash value come from?
Right. And so the cash value is kind of a function of the premium that you pay in, the dividends and the non-guaranteed dividends and the guaranteed growth, right? That's where your cash value is coming from. And it gets a little complicated. The way I usually explain this is that every penny you put in the policy of premium is buying death benefit.
Okay.
Cash value is a byproduct of the death benefit that you buy. So if I put $10,000 a year into this policy, I'm buying $10,000 of death benefit. And this is where it gets complicated. What I do in my specialty is how to design or structure these contracts so that you get the most cash value from every premium dollar as possible within the IRS guidelines.
Okay.
So we're using some riders to do that. So some of your premium is buying what we call base premium, base policy. That's your plain Jane whole life contract.
Okay.
Some of your premium is buying what are called paid up additions,
Okay.
which is a rider that we add to the policy. This is where most of the early cash value comes from. So we're usually designing it to get as much as possible into that paid up additions. And then some of it will buy some term rider. So term rider is term insurance that we use in order to maximize these IRS guidelines that allows us to put more money in the paid up additions. Okay. So term produces death benefit, but it does not produce any cash value. So it's a very small portion of your premium.
Okay.
The paid up additions is essentially like buying little pieces of life insurance that are all paid up for the rest of your life at once.
Okay.
And so they produce cash value at a pretty high level immediately when they're purchased. That's why we try to get most of the premium in there. Then the base is kind of like the chassis that everything's built on. So it's like traditional whole life where it is you're buying death benefit and it's producing cash value, but it takes time to build up.
Okay.
So the paid up additions produces that cash value right away. The base takes some time to build up and the term's a smaller amount and we don't get any cash value from it. So again, very complicated. I don't want to get lost in the weeds with structure, but so is essentially that cash value is coming out of that structure, that design, and it has to be, and everyone is unique because it depends on the amount you can put in or want to put in.
Yeah.
So that's where that cash value comes from is I'm paying $10,000 of premium. The way I translate this is somewhere in the neighborhood of 80% of that premium will be available as cash value to you in the first year.
Okay.
And then in the next year, it'll be about 82% of that premium. And in the next year, 85% of that premium. And in the next year, right, it builds up that way over several years.
Got it. You guys, this is complicated. So don't feel like you're dumb if you're not quite getting it. Listen to it again. And better yet, get on a call with John. I have another question before I give him the information because I was like, how is it that the cash value increase is guaranteed? What are insurance companies doing with the money to be able to guarantee that that's happening?
That's where those regulators I mentioned earlier come in, that an insurance company has to make certain investments. The other thing that these companies, so one company in particular I work with was founded in 1905.
Okay.
And they have paid a dividend to their policy owners every single year since 1905, which means they've performed better than expected every year for 118 or 119 years. And so we're talking about companies with a very long view. And so when an insurance company makes an investment, they're literally looking at 100 years, right, to plot that out. So insurance company actuaries are probably some of the smartest people on the planet. And they've been following a lot of these things for literally centuries when they do their thing. So actuarially, they are investing in, to simplify it, they're investing in highly rated corporate bonds, government bonds, mortgages, things of this nature that are very, very highly rated, not very subject to volatility. So they're pretty predictable, as much as anything is predictable. And they're operating on an extremely long timeline. So all of those things guarantee certain level of results.
Okay. John, thinking back to 2008 when we both had our life transitioning moments, did any insurance companies need to be bailed out at that time, or was it all banks? And I'm honestly asking because I don't remember.
Yeah, no, there were no significant life insurance failures in the 2008 crisis, and everyone's aware there were lots of bank failures. So there is that state commissioner system that I mentioned. Part of that system of the regulating the companies is sort of a safety net system where the industry itself can kind of function as their own bailout mechanism.
Okay.
It's funded by the carriers and administered by the insurance commissioner system. And so that system is there. Very few people are really aware of that. And it is not like FDIC. I want to make that very, very clear. It is not a government funded security kind of thing. It doesn't work that way. But essentially, because that system's in place in the United States, we really haven't seen a significant life insurance carrier failure since back in the 80s, late 80s.
Okay. All right. This has been fascinating. I have one of these policies, but I learned a lot about it from you. Thank you so much.
Oh, my pleasure.
How can people who have been listening and like, I need to understand more about this, how do they get in touch with you?
So I have a landing page set up. This jumponwithjohn.com.
Okay.
And jumponwithjohn.com. And basically that takes you to a page where you can click on my calendar and schedule a free 30-minute strategy session. And that is the number one thing I stress is have a conversation with someone like me. I would love for it to be me, but hey, I'll have a conversation with someone like me that understands the concept, uses it themselves, and most importantly, isn't going to push it on you, right? I consider myself an educator, not a salesperson. And I really just want to share all the information and knowledge that I have about this so that someone can get to a point where they go, okay, this makes sense. I've learned all that I want to learn. Now I'm ready to do this. And until they raise their hand, right, that's when I'm here to help them. And you want to work with someone like that, even if it's not me.
Yeah. So that was important. Thank you for saying it, John, because I was going to ask, what do people need to have prepared when they get on that call with you? Because I think that holds people back. They think they need to know their whole financial situation to even have a conversation about their finances. And people don't want to be like, he's just going to try to sell me this thing. It's like
they're waiting for the sales pitch.
Ron just said he's not going to try to sell it to you. He wants to explain it to you, and you're going to raise your hand and say, I want to buy it. Or you're going to walk away and say, thank you, John. I appreciate the information. So go on.
Absolutely.
What's the site again?
Jumponwithjohn.com.
Jumponwithjohn.com. It'll be in the show notes because if you're like me, you forgot it already. Jumponwithjohn.com. Do it, you guys. It's like, I got 30 minutes to hear about what this is and how it can help me and how my life can be different. You got nothing to lose. 30 minutes. I really, really urge you to do so. John, thank you so much. I really, really appreciate it. This was really good. Again, I have a policy myself and you really helped me understand it better. So thank you.
Good. That makes me feel good. That's what I'm here for, is to help people understand this stuff.
Perfect. Thanks so much. We'll see you next time, guys. Remember, every woman should have the financial ability to walk away from any job or relationship that is not in her best interest. That is what we believe at Money with Mission. Take care.
You've been listening to Money with Mission. There are projects happening right now where you can have a great financial return while positively affecting the lives of others. To learn more about our opportunities, go to moneywithmission.com.